Assalamu alaikum. Let's just start this question number 3 of December 2023. It's a 25 marks question. Let's see. Advise on hedging strategies based on the hedging choices that the finance department is considering for the loan of $24 million, assuming their central bank base rate rises to 5.9%. That is an assumption. The investment of 18 million means lending, assuming the central bank base rate falls to 4.5%. One thing is for sure, in case of borrowing, we have a risk of rise in the interest rate, and when it comes to lending, we have the risk of fall in the interest rate. And according to that, they have given us the information. Support your answer with appropriate calculation and discussion, 13 marks. Okay. Around 4 marks they will be given you for the valid available discussion, whatever it is. Discuss the queries raised by each of the directors. And you will be getting professional marks for analysis and evaluation. Means you should know the data very well. Skepticism, if any information which you can challenge logically. Commercial acumen, the way you make decision, it should look that a wise person is making the decision. Let's read the question. The following exhibits available on the left-hand side of the screen provided information relevant to the question. ABEEL Fall Companies Interest Rate Hedge. Directors' queries about hedging. This information should be used to answer the question requirement within your chosen response. Either you're going for MS Word or spreadsheet. ABEEL Fall Companies Interest Rate Hedging. ABEEL Fall Companies planning to a change in its arrangements for distributing its products. The company wishes to dispose of its large distribution center in the middle of its home country and invest the proceed of sale into smaller distribution centers, okay? One in the north and other in the south of the country. It is currently first Fab X8. This is extremely important for us. They're giving us today's date is given to us, which is first Fab X8. Because of expected timing differences in 3 transactions, ABEEL Fall Company expects to take out a short-term loan of 24 million from 1st May X8 to 1st September X8. So the time period of the loan is 4 months. Time period of the loan, if you count from 1st May, basically the entire months of May, June, July, August. So 4 months, because transaction rate is because the time period starts from the loan from 1st May till 1st September. So they have time period of borrowing is 4 months. It then expects to make a short-term investment of 18 million. Short-term investment of 18 million from 1st September X8 to 1st Fab X9. Simply, you need to count from September till 31st January. So we have 5 months. 4 months of X8 and 1 month of X9. So time period of investment is 5. So time period of borrowing is 4 and investment is 5. ABEEL Fall Company intends to hedge interest rate risk using derivatives. The terms offered on derivatives are based on central bank base rate. It can be assumed that future or option contracts are settled at the end of each month. Basis can be assumed to diminish to 0 at contract maturity at a constant rate. Obviously, when you will be writing, so you have to challenge this information that practically a basis will not be 0. A basis does not reduce gradually, and it will not be 0 at maturity. Based on monthly time interval, it can also be assumed that there is no basis risk. Obviously, you will have to write that basis risk will be there. There are no margin requirements. Obviously, skepticism does apply here. Practically, margin requirements do exist. So you have to fulfill the margin requirements. 24 million loan. ABEEL can borrow at central bank base rate plus 40 basis point. We know that when you will be writing the actual result, only at that time we need this 40 basis point. At present, the central bank base rate is 5.1%, which means that if central bank base rate is right now 5.1, take it like a LIBOR, 100 minus 5.1. So 100 minus 5.1 means right now the spot price is 94.9. Right now, the spot price is 94.9. Okay. Commentator expects the government to raise the central bank base rate by 0.8% to 5.9 before 1st May X8. They're going to take loan on 1st May X8 for 4 months. Okay. ABEEL companies finance department intends to use FRA or futures to hedge the loan. It has already found out that using a forward rate agreement for the loan would result in a net payment of 4,61,600, which is an effective rate of 5.77%. So they have already solved FRA for us. So that will help us in choosing either should we go for FRA or any other technique. 3 months future, 500,000 contract size. So I think I did mention in my regular lecture as well. If you have not been given tick value, you can calculate the tick value. Simply 1 upon 10,000, 3 by 12. So the tick value is 12.5. Prices are quoted into 100 and annual yield percentage. Obviously, we'll go for June. Why we are going towards June? Basically, the transaction date is on 1st May. So for the future, we'll choose the June option, and it is mentioned in the question contract they mature at the end of the month. So logically, 2 months before the expiry, we'll be basically utilizing the futures. We'll be closing out the futures. Another thing, right now we are dealing with the borrowing. In case of borrowing, the hedging strategy is simply sell now, buy later. So if we quickly start the borrowing scenario. Okay, another thing is they have already solved FRA for us. So you should take the FRA result, just copy paste. Why do we need the result of FRA even though it is already solved? Because we do need the result of FRA in our discussion. So it is highly recommended. You should just copy paste the FRA result. So in part A, you need to hedge $24 million loan. In FRA, they have given us net cost. What is it? The net cost they have given us 4,61,600 and effective rate is 5.11. Forward rate agreement. They have given us a net cost 4,61,600 and effective rate was, I think, 5.77. Now let us solve with futures. Interest rate futures. Interest future hedge. Okay, let's mention the date, which contract. So we'll go for June. June future. Hedging strategy, borrowing is always sell now, buy later. Let's calculate number of contracts. $24 million. Time period of the borrowing is 4 months. Let me use a calculator. Let's see how many contracts. We are having 64 contracts. So there's no question of under or overage. Let us also calculate tick value. They have not given us. Now let's calculate the basis. Spot price we have calculated. That is 100 minus 5.1. 100 minus 5.1 gives me 94.9. Let's take the future price. Which future we have to take? The June one. It is 94 point, let me write 94.55. 94.55. So 94.9 minus 94.55 is 0.35. Now listen and listen carefully. Today's date is 1st Feb. Okay. From 1st Feb, if you count till 30th June, so you have 5 months. Transaction date is on 1st May. So the contract which is going to mature on 30th June, you want to close that contract on 1st May. Means 2 months before the expiry. Total time period from 1st May till 30th June is 5 months, and we want to actually close this contract 2 months before expiry. So here comes the unused basis. Uh, 0.35 2 by 5 gives me unused basis 0.14. By using the unused basis, what do? We calculate future closeout price. By using unused basis, we calculate future closeout price. It is mentioned in the question that LIBOR center or central bank, whatever you say, rate can rise by 0.8%. If it rises by 0.8, then your base rate becomes 5.9%. Future closeout price. When base rate is 5.9%. Can I say 100 minus 5.9? I'm getting 94.9. And never forget the relationship of day one. In day one, look at this. Spot is higher and future is lower. Can I say in day one, if spot price is higher and future is lower, then when you will be calculating the closeout rate on that day, you have to follow the same relationship. On future closeout, when you are calculating on that date, again, spot has to be higher than future closeout price. So less unused basis. 0.14. I'm getting 93.96. Strategy is sell now, buy later. So you'll be selling at this price. Will be obviously entity will buy future at this price. So there's a gain on future. So outcomes of hedge. Base rate is 5.9%. It is mentioned in the question that company can take the loan at base rate plus 0.4 basis. It means actual borrowing cost. The amount of the loan is 24 million. If we add 0.4% to 5.9, we'll get 6.3%. Time period of the borrowing is 4 months. So 24 million. I'm getting 5,04,000. We are having gain on future, so the gain on future will reduce your net borrowing cost. Less. We have sold futures at 94.55. We are buying them at 93.96. Multiply by 100, multiply by the tick value, multiply by number of contracts. Let's see how many contracts we calculated. 64. Calculator. So 94.55 minus 93.96 into 100 into 12.5 into 64. The gain amount is 47,200. 504. Net borrowing cost is 4,56,800. Let's calculate effective annual interest rate. Four lakh 56,800 divided by 24 million. 12 by 4 into 100. I'm getting 5.71%. So let's go back. That is all about loan. Just let's talk about now investment. $18 million investment. ABEEL fall company invests at a central bank base rate minus 30 basis point. Whatever is the base rate minus 0.3%. And we know that when we'll be writing actual outcomes at that time, we are going to take this 30 basis point. An election is due on 1st July X8. The main opposition party has promised that it will reduce the central bank base rate from whatever level was before the election. Commentator expects that the central bank base rate could be minimum 4.5%. If the main opposition party wins the election, so it will go down to 4.5%. At present, the election results cannot be predicted with confidence. Okay. It can be assumed that interest rate will not be reduced if the current government wins the election. Fine. ABEEL Fall Company's finance department has already found out using FRA, they have again solved FRA over here, that investment would guarantee 3,78,750. Okay. With an effective rate is 5.05%. Okay, just if I quickly write the results of FRA. Now you're dealing with 18 million, can I say, investment. Net interest income or receipts. Net interest income they have given us 3 lakh. It is 3,78,750. 378,750. And effective rate they have given us 5.05. 3,78,750 and effective rate is 5.05%. Okay, now what do they want us to do with this 18 million lending? Which technique should we need to use? Okay. Because of the uncertainty surrounding the election result, the finance department is looking to buy call option. We know that in lending, you go for call option as an alternative to use forward rate agreement. Okay, options 3 months September future. They've given us 500,000 contract option premium. Okay, fine. The good thing is they have just given us one exercise price, which is very much logical because practically you don't have two exercise prices. Practically everyone will have one exercise price. Another thing is lending. In lending, obviously you always buy call option. So they have given us call option. But a very important point which you need to know is basically we cannot solve the question by call option or put option or simply by interest rate options until unless we have future closeout price. Logically, we will be comparing call option exercise price with the future closeout price. So we have to calculate future closeout price. Otherwise, we will not be able to solve the question by using options. That is the main point. So let's go for interest rate options. Interest rate option hedge. Directly, I'm just writing hedging strategy. Buy call option. Can I say the number of contracts? We'll be using the same formula, number of contracts. 18 million. 500,000. Now this time we have to take the time period of lending. And it is from 1st September till 1st September X8 till 1st Feb X9. So it makes 5 months period. Let me use the calculator. 60. Number of contracts are 60. There is no need to calculate tick value again. If you have time, you can do that. Otherwise, just I'm writing it directly. Tick value. Stick it value, not tick value. There's only one call option. We have written that hedging strategy. We have written number of contracts. Actually, no, we need future closer price. 100 minus 5.1. This is your spot price. Now let's go towards future. Can I say logically now September future is relevant for us, not the June one? Why? Because lending company is going to deposit the amount on 1st September. So obviously we need a future which matures on transaction date, otherwise immediately after the transaction. So September future is relevant for us, 94.5. 94.5, 94.5. Okay, we'll be working only by using one assumption. The name of the assumption is basis reduces gradually. Now try to understand. Future will mature on 30th September. The future which we have chosen, the September future matures on 30th September, but we will exercise this option on 1st September. We'll close this option on 1st September. It means 1 month before the expiry, we will close the contract. Repeat. This future matures on 30th September. We will close this contract on 1st September, means 1 month before the expiry, which means 1 month basis will be unused out of 8 months. How did I get this 8 months? Basically, today's date is 1st Feb, X8. It is mentioned in the question. And we have chosen the future of 30th September X8. If you count the time period, these are 8 months. So the total time period from today's date till 30th September is 8 months. So logically 0.4 basis is representing the time period of 8 months, but we will close this contract 1 month before the expiry. So unused basis will be of 1 month. Unused basis. I'm getting 0.05. Unused basis, I'm getting 0.05. Okay. Now let's calculate future closer price. Let's see what they have written in the question, how far it can reduce base rate. 4.5. It can go to 4.5. Okay. When base rate is 4.5. Spot price is 95.5. Okay. Now look at the day one relationship. Please try to understand. In day one, spot is higher than future. So when you'll be calculating a closing rate on that day, again, the same relationship you have to follow. So let us deduct unused basis. Future closer price. Now we have to compare options with the future closer price. Let's go for option. Premium, let me write, the premium is 0.298. Exercise price is 94.75. 94.75, okay. Outcomes of option, let's say hedge. Exercise price, we are talking about call 94.75. Call means right to buy. Future closeout price. Future closeout price. Can I say we will exercise the option, yes or no? We will exercise the option because you will be buying at 94.75. You will be selling at 95.45. So option exercise, the answer is yes. If I calculate gain in basis points, (95.45 minus 94.75), can I say into 100? That will give you the gain in basis points. Let me use the calculator. 95.45 minus 94.75. Gain in basis point is 70. Okay. Now let's go for actual interest income. Can I say 18 million? Now base rate will be 4.5. It is mentioned in the question when you are going to invest. It will be base rate minus 0.3. It will be base rate minus 0.3. So from 4.5, if I deduct 0.3, it is mentioned in the question, okay? So you will be having 4.2%. And time period of investment is 5 months. Let me use the calculator. 18 million. 3,15,000. Can I say gain on option will increase the overall return? Gain on options. If you want, you can directly use the 70 basis point. If you're using the 70 basis points, then just multiply this with the tick value, which is 12.5, into number of contracts. How many contracts we calculated? 60. So 70 multiplied by this. Gain amount I'm getting is 52,500. Obviously, either you exercise the option or not, you have to make the payment of premium. Can I say payment premium will reduce your overall return? Premium paid. Zero 0.298. 0.298. 0.298 into 100 into tick value into number of contracts. The premium amount is 22,350. Your net income, net assets. I'm getting 3,45,140. Effective annual interest rate. Can I say 12 by 5 into 100? I'm getting that's 4.602%. Now let's come here. Now discussion. Please, you have to listen the discussion nicely. Then we'll be discussing part B as well, inshallah. I strongly believe the calculation part should not be disturbing at all. If you have a really good practice, and I did mention many times also, that is, see, it is very much possible the way we have solved, the way examiner has solved, there's a greater chance. Steps could be, different, but obviously end result has to be same. Sometimes what happens is students, they just see the different result, then they just ignore what they have studied. That is dangerous. The way you have studied, please follow that. So there is a possibility, and it happens. Sometimes your steps and examiner steps would be same, but sometimes may not be the case. Okay. Let's change the color of. Okay. FRA. The net cost is 4 lakh 61,600, and this is the effective rate. Okay. In future. Okay. Just listen. Only the discussion. In part A, you will be just writing that in case of borrowing, interest rate futures are having effective annual interest rate 5.71%, which is lower than effective annual interest rate of FRA. On this basis, futures are more beneficial for the company. Okay. After writing this, you have to then mention few other things. You have said that futures are better. Okay. But then you'll be saying that results of the future, they depend on the assumption that basis reduces gradually, and which is not true in practice. Another thing is, we have ignored the margin deposit requirements. Practically, entity will have to bear the margin deposit requirements. Okay. When it comes to FRA, in FRA, obviously, there is no margin deposit requirement. There's no such. Actually, FRA only depends on the financial institution, the bank from where you have taken the FRA. That bank has to be very strong. Because in FRA, there's a risk. What if the time comes and you want to exercise the, obviously when you want to fulfill the FRA, there's a slight chance, but there's a chance that that financial institution might go into default. But it rarely happens. Normally, I would say those banks, they are giving you FRA facilities. Obviously, those banks, they provide you FRA facility. They are very strong. They are financially very strong. So simply what we have, so far we have just said, go for futures, but future is better, but you have to consider other things as well. Now, only this part we have set for the loan. Okay, now let's go for deposit. Now, in deposit, actually, what is happening? Deposit. Effective rate is 5.05%. Oh, this is better than what we have calculated. So simply we'll be saying that FRA results in the higher guaranteed return. Then can I say options hedge? So simply, in case of lending, clearly FRA is far more better than options. This is what you have to actually write in part A discussion. Now let's go back to the question, what they are saying in other areas. Discuss the queries raised by each of the director. Let's see what they are saying. Director queries about hedging. At the last board meeting, ABEEL Fall Company's finance director explained to the board the possible strategies for hedging the loan and investment. She has received a number of queries from directors about the plans. Director A stated that ABEEL Fall Company should not be using derivatives, okay, as trading in derivative was not part of the company's normal activities. Therefore, shareholder would not expect the company to use derivatives. Now listen and listen to me carefully. Obviously, we just need to answer the queries of Director A, B, C. How examiner has answered the queries, how we are answering the queries, it could be very different. But whatever you are writing, it has to be logical. If it is logical, you will get marks. Now listen. Let's answer Director A. A very important point. When ABEEL Fall is using derivative, so they are not doing trading in derivatives. The derivatives are being used for hedging. They're not using derivatives for speculation. So when the shareholders, they would come to know that organization has used the derivatives for hedging, it will not create the problem. Problem will only be created if the company uses the derivatives for speculation purposes. So right now they're not using the derivatives for speculation purposes. So it's a normal practice using the derivative for hedging purposes. So simply we'll say Director A, they're not actually, companies not actually trading in derivatives. They're not trading in derivative for the sake of speculation. It's not, they're not doing gambling. So right now they are using derivatives for hedging, which is perfectly fine. So when the shareholders will come to know this usage of derivative for hedging will not create any problem. I hope Director A query is resolved. Yes or no? Is this clear to everyone, Director A queries? I hope it should be clear. Now Director B. Let's see what he's saying. Director B understood that futures or forward rate agreement might be the best solution if the central bank rate rose up to 5.9%. or fell down to 4.5. Now stop. What director B is saying? That's very interesting. Director B says that I understood that futures and FRA, they might be the best solution if the rate rises to 5.9. Now, why he's saying it is best? Let me tell you. If the rate rises to 5.9, futures gives you the effective rate how much? 5.71%, which is obviously lower than what they are saying. And never forget one thing. Please never forget one thing. I did mention many times, we do not have any hedging instrument which hedges CRP for you. Can I say logically 5.71 is having the CRP 0.4 also? If I deduct the CRP, so logically your rate is 5.31%. Did you get this point? So there is no instrument. We don't have any instrument which can hedge credit risk premium for us. So logically, when the base rate is 5.9, if I exclude 0.4 from 5.71, so your rate is actually 5.31. So that's for sure. If rate rises to 5.9, okay, which does not have CRP, then logically by using future, your effective rate, if I reduce 0.4, it comes to 5.31%. So obviously future gives you the best result. When the rate falls to 4.5, when the rate falls to 4.5, then what FRA gives us? I think I did right, if I'm not wrong. FRA gives you 5.05%. FRA gives you 5.05%. FRA gives you 5.05%. Again, I would say the best. Yes or no? Because if your rate goes to 4.5, now listen. If your rate goes to 4.5, try to understand. Your effective rate in FRA is 5.05. And logically, from this 5.05, you have deducted 0.3 CRP. If I don't deduct this 0.3, so logically, this is what I'm getting. Did you get this point? 0.3 we have deducted, that is CRP. So try to understand that if the base rate goes to 4.5, for you, logically, the effective rate will be 5.31 without taking the impact of CRP. So that's for sure. When the rate rises, futures are best for you. When the rate falls, then FRA is best for you. That's for sure. But what he wants to ask, whatever he has written, it's okay, correct. However, she queried what would happen if rate did not rise as high as 5.9. Now they are saying, what if the rate does not rise as high as 5.9? Now listen and listen carefully. What if the rate does not rise as high as 5.9%? Still no issue at all. Why? See, what was the rate? Effective rate, effective rate, effective rate. It is here. Effective rate is 5.71%. Please try to understand. If I deduct 0.4, which is CRP, so it is actually 5.31. Now listen, even the rate does not rise as high as 5.9. Even it does not rise as high as 5.9, but still, if the base rate is more than 5.31%, if the base rate increases more than 5.31%, still futures are better. Let me repeat, it is not necessary that it has to rise, let's say 5.9. Even if it rises more than 5.31%, still futures are better for you. even the rate rises not as high as 5.9, it rises less than that, still futures are better for you. There's no issue at all. So it is not necessary that your rate has to rise 5.9%. Even it goes till 5.31 is good enough. And then they've said one more thing. Nor did they fall as low as 4.5. Nor they fall as low as 4.5. Now listen. Even it does not fall as low as 4.5 is still what FRA is giving you. I think in receipt, FRA gives you 5.05%. If I exclude the impact of CRP, logically this is your rate. It means even your rate is not reducing till 4.5%. Let's say it goes till 5%, maybe 5.1%, maybe 4.8%. Still, FRA gives you 5.31 after excluding the impact of CRP, okay? So it is not necessary. What do you have to now? How do we reply Director B? We'll say that it is if rate is not rising as high as 5.9, but simply we'll say if the rate rises over and above 5.31%, still hedging will be more, the future will be more beneficial for the company. Even the rate reduces, not reduces to 4.5, let's say it is still, it goes down to, let's say, 5%, 4.8, 4.9, or even somewhere between 5 and 5.35, still FRA is better. Because listen, if your actual rate is 5%, try to understand, if I deduct 0.3, so you'll be getting, if you're not doing hedging, you'll be getting 4.7. Still FRA gives you 5.05. So I hope the point is clear. When it comes to increase in the interest rate, if it rises over and above 5.31, still futures are better. If it falls even not to 4.5, it remains over and above 4.5, but does not exceed 5.35, still FRA is better. So we'll say still chosen options are better. Now, what about Director C? C stated options should not be used to hedge 18 million investment, as they would never be the best choice because of their premium. Their best choice would not be the hedge at all. No. See, when it comes to their saying, obviously, when it comes to Director C, we will say that in case of investment under interest rate options, effective rate is lower. Am I right? Lower than FRA. Why it is lower than FRA? Because options are always expensive due to payment of premium. So payment of premium actually makes the option the worst choice. That is why option should, obviously hedging through option is not advisable. As to this extent, we agree with the Director C. But saying this, we should not hedge, that is not good option. Why? See, if you're not hedging, okay, then you will not be getting the effective rate which FRA gives you. FRA gives you the effective rate 5.05%. Not hedging means there's no guarantee that you will be having an effective rate in case of investment 5.05%. Your interest rate could be lower than this. So hedging through option is not advisable because the premium payment makes the hedging interest rate option the worst option. But saying this, that options are not better, company should not hedge, this is not good. Because FRA gives you the guaranteed return of 5.05%. So when it comes to Director C, we will say it's better not to choose the option because of the premium payment, but still, hedging is better than not being hedged. So I hope students that this question should be clear to everyone. So just I wanted to discuss with you. At least I would say the calculation part was straightforward. I use all those steps which we have used in our regular classes. Out of these 7 marks, see, when it comes to this 7 marks question, this is not a question which you can read the entire book and give the answer, not possible. Out of this 7 marks, you could have taken someone whoever has attempted should have taken, I would say, at least 3 marks. Because director C, you should have replied to director C, and I would say director A at least. If someone was not able to answer director B, it's fine. Out of 7, you're getting 3 marks. That's good enough. But the first question of 13 marks out of 13, 4 marks were for the discussion. That was the easy part. So dear student, that is all from my side. Thank you very much that you people have taken out time to attend my class. So thank you very much and have a nice life. Thanks a lot.